Welcome once again to the Genghis Weekly Investor Briefing. This is the first briefing for the year 2021, and we are thrilled to have all of you here. Thank you for attending. Now, in this, for new members, for the people who've started today, the Weekly Investor Briefing covers a recap of the previous week's major developments in the financial industry, that is the fixed income and the equities section, and then gives you a prediction of a strategy to trade for this coming week that we are starting. So with us, we have Churchill Ogutu, who is our head of research at Genghis Capital, and Gerald Murioki, who is our research analyst also at Genghis Capital. Gerald Murioki will be covering the fixed income, and then Churchill will finish off with the equities, and then Churchill will finish off with the fixed income. Over to you, Gerald.
Thank you, Daniel, and good morning, all. So we'll begin with the recap of last week of how markets basically performed. So some slight profit taking with the NASI down about 2.1%, and NSE20 about 1.7%. So this basically is coming in from 2 weeks of gains. The first 2 weeks of January were recording gains, but some slight profit taking over last week. Turnover has steadily been increasing for the 3 weeks of trading so far to about 2.7 billion. But however, this is still quite low compared to the ideal weekly averages. So still, we expect to see turnover pick up as more investors come back to the market. Top gainers last week: Express, Uchumi, and Home Africa, basically the retail kind of stocks. Top losers again, Eveready, Bank of Kigali, and the Unga Group. So this Eveready, Unga, basically the retail kind of stocks, but Bank of Kigali was basically a large trade during the week. Top traded: Safaricom, KCB, Equity, and Bamburi, basically the usual large cap counters that tend to be quite liquid and also a favorite of most institutional and foreign investors. From the foreign end, participation came down to about 50%. I think the prior week was about to 72%. So a lot more local investors coming back to the market. Basically, foreign investors still quite bullish in the market. Inflows about 23 million. I think so far this month I've seen quite some inflows from the foreign end. And basically they are very keen on Safaricom and Equity Group last week. Safaricom has been under this trend for quite some time. And then we have foreign exit from KCB Group, BAT Kenya, and EBL. And for these counters, we tend to see every other week, we tend to see switching between the buy side and the sell side from the foreign end. So top traded by foreign investors: Safaricom, KCB, Equity, EBL, and BAT Kenya. You'll see that these are the large caps, the most liquid, and also the stocks that have the strongest fundamentals in the market. In terms of where we are trading at compared to peers, if you look at weekly performance across SSA markets, basically about 0.2%. So some bearish activity across the week for most African counters. And then if you look at year-to-date basis, markets are quite positive on average, about 0.4%. Our market is about 1.8% up. So it is those 2 weeks of January that had quite some inflows in the market. In terms of market price earning ratio, slightly higher compared to African average at about 11.5 times. And then the dividend yield is about 4.4 times against the average of about 5.4 times across SSA. So trading ideas for the week. So long term, we are biased towards strong stocks. I think for most of the investors that were with us during the playbook, we come up with recommendations across the market from telco, banks, and manufacturing and other sectors. So we still believe that the market where it is trading at currently, there's still a lot of value for most of the counters. I think it's only Safaricom which has rallied quite substantially, but for most other stocks, they are still trading at discounted multiples. This week, our focus is on Kenya Re. I think the stock has rallied again about 15% so far. No, 8.2% so far this year. Quite a good return. But despite that rally, the stock is still trading at below net cash per share. So it's like the market is still discounting the cash the business has in terms of assets. So net cash per share is about 2.7, and then we have the market price at about 2.5. So we still quite some headroom, upward headroom for market to catch up with the net cash per share. So basically, this is a deep discount value stock, as we have mentioned previously. Short-term investors, we are recommending short-term investors to basically cash in on the 21% gain so far on Bamburi Cement. So I think a return of 21% for in a period of about 3 weeks is something that investors can basically look at and cash in on some of that gain. Especially if you are speculative or you are short-term investors, I think this you can lock in the 21% and look at other opportunities in the market. Corporate calendar. So far this year, this year in January tends to be a bit quiet, but in the next about 2 months, we'll start seeing a lot of corporate activity. Sorry. Yes, so from next month and also March, yes, we are going to see a lot of corporate activity. Earnings, it will be earnings seasons, especially full year earnings from the banking sector, from manufacturing sector. Basically, a majority of the stocks will be coming in with their full year releases. Again, tends to be when we are under this season, tends to be activity in the market tends to be quite high. So expect again that to reflect in the market going forward. So over to Churchill for the next session.
Churchill.
Thanks, Gerald. I don't know whether I'm audible enough.
Yeah, kindly add your volume.
Hello, can you hear me?
Yes.
Yeah.
Okay. Okay, let me share my screen. Just a moment. Okay, so let me walk you through the macroeconomic bits. Let me start with this side. The review for last week. The news that came out that we are highlighting in our reviews now, the cumulative December 2020 revenue and net expenditure highlights. So this is ideally the revenues and non-net expenditure between 1st July up until 31st of December. So the first half of the fiscal year. The fiscal year starts from 1st July up until 30th of June. So these numbers are pretty much the first half numbers. So in terms of ordinary revenue, those numbers came in at 726.5 billion, of which tax receipts was 673.6 billion, while non-tax receipts were 52.9 billion. So this is the cumulative numbers between 1st July up until 31st of December. And then specifically for the month of December, those tax receipts numbers was around 148.9 billion. For those of you who've seen the KRA numbers, KRA put out a presser early last week to the effect that tax revenues in the month of December was 166 billion. But the numbers we are seeing from Treasury is 148.9 billion. So this pretty much stems from the fact that there are some levies which Treasury sees as appropriation in aid, but KRA now aggregates them as tax revenue, things to do with the road maintenance levy and some other levies. So those are not included in the numbers that are reported by Treasury, whilst KRA now includes them. But these are some of the minor differences for some of you perhaps who have seen these numbers on a monthly basis. 148.9 billion vis-a-vis KRA's 166 billion. So it's stemming from that fact. In regards to gross domestic borrowing in the first 6 months, as per the report, it was 385.8 billion, of which there was 26.2 billion that was borrowed towards arrears, funding the arrears to counties in the last financial year. That number was 26.2 billion. And then we have the domestic debt maturities, which is also included in the gross domestic borrowing. So this is 73.6 billion. So you can imagine an analogy that comes to mind that you have, say, a teller, you owe teller 10 shillings, and then you go to branch, borrow 20 shillings to pay the 10 shillings to teller, and then remaining with another 10 shillings. So that's the gross domestic borrowing, 385.8 billion. But then we have some domestic debt to be maturities now to the tune of 73.6 billion. And now moving to the expenditure side, we are still behind in terms of government spending. Ideally, at this point in time, being the half mark point of the fiscal year, we should be around 50% in terms of the numbers that you are spending. But looking at the numbers, recurrent spending, that is 400 and close to 460 billion. That was roughly 43% of the amount that had been spent in the first half period. Development spending trailed further, 139 billion had been spent, but that came to around 39% of the total development expenditure in the financial year. And now trailing further behind is counties disbursements, 124 billion shillings, which was roughly 32% of the monies that was spent to the counties. But that said, there's been some strings of announcements by Treasury this month to the tune of some increased expenditure, some increased disbursement to counties. There was 26 billion that was sent last week. The other week, there was another 24 billion. So you're saying that there's been some traction towards counties disbursements over this in this month of January. And looking at the public debt, sorry, it's not visible, but for the first half period, that was 400 and close to 414 billion that had been that were part of the public debt service obligations. So as a percentage of ordinary revenue, that's around 57%. And speaking of public debt obligations, the overall amount of monies to be spent to service the debt is around 904 billion in this financial year, of which now that we knock out the 414 billion that was spent in the first half period, that comes to around 461 billion that was still pending in terms of public debt service at the start of this year. But then again, in light of the DSSI, that is the Debt Service Suspension Initiative, that at least unlocked 32.9 billion from the Paris Club. Last week, there was an announcement that there's another additional 27 billion that was unlocked by China in terms of not servicing the debt between 1st of January up until 30th of June. So that means that close to 70 billion of the monies that we're supposed to have paid in terms of servicing the debt have now been suspended up until from fiscal year 2022-2023. So we are seeing close to 12% of the original 491 billion, which has been suspended. So 70 billion from the 491 billion, 60 billion of the 491 billion will not be paid out. So we are seeing a lower number, 431 billion. But still, it's not something that could move the needle a bit. We are seeing that public debt servicing in the second half of this financial year is still elevated. So moving on to the calendar for this week, tomorrow on Wednesday, we have the CBK Monetary Policy Committee meeting, which they'll be able to review the central bank rate, that's the benchmark rate. Right now is at 7%. We still expect it to be maintained at that 7%, just looking at the negative output gap that we have in the economy. By that, I mean that the potential GDP is still punching below its weight in terms of meeting its potential, its overall capacity. So because of that, and also some other factors, private sector credit growth, the numbers that we have is at end of November is at 8.2%. But drilling down into the numbers, we are seeing that there hasn't been a robust credit mediation. Banks are still risk averse in terms of lending to the private sector. So because of that, we are still seeing that there's a high likelihood that the MPC will retain the central bank rate at 7%. The other also issue which they'll be looking at, of course, is the inflation and numbers, where we are, and the outlook for inflation. The January inflation numbers will be out by the end of this week. This is on Friday. We expect it to increase, edge up slightly higher, primarily stemming from the cost inflation pressures. VAT increased, reverted back to 16% from 14%, and that has led to some cost push buyers, and we expect it to filter through the numbers that will be announced this week. And now, if I may take you back to the MPC meeting, despite the fact that, say, cost inflation might go up, I don't think that cost inflationary pressures can be addressed by a reduction in the CBR. So that just even cements, solidifies our view that the CBR will still be retained at 7%. Moving on to the other reports that have still been pending. This is the third quarter GDP and balance of payment reports. Usually these numbers are released with a lag of 1 quarter. So third quarter ended in September. So by end of December, we should have received these numbers. But right now we are 25 days into January, but you haven't seen this number. So it's still up there in the cloud. If at all it will be released either this week or next week, we still don't have any clarity around that. These numbers. So moving to the fixed income review for last week, in terms of the secondary market activity, there was a decline to the tune of 35% to 4.7 billion that were traded cumulatively last week. The focus of the week was on the infrastructure bond, which I'll talk about a few slides later on. And of this 4.7 billion, the trades that were executed majorly on the infrastructure bonds, that is the IFBs, and also the 15-year papers, the bonds that had an initial maturity of 15 years. So those were the ones that we flagged that were traded the most last week. Moving on to the T-bill segment, overall T-bills was 20.3 billion, and that was a performance of 84.5%. Comparing to the previous week, where we saw the first positive numbers in 8 weekly auctions, so that was a dip week on week in terms of performance. So we are seeing that yields have been on an increase starting from July, whereby those record liquidity in that month. But after that, we've seen that yields have been on an increase, averaging 1% since mid-July levels. And this month, they have increased by roughly 0.11% across the board. So moving on to the liquidity trends, the interbank average rate declined by 0.18% to 4.43%. That was the average that was traded in the interbank market. In terms of open market operations, that is what CBK comes in on a daily basis, assess what's the liquidity level. Is it high? Is it low? So last week, the beginning of the week, we saw that CBK was coming into more liquidity. So that just is a pointer that there was excess liquidity in the market. But come Friday, they were on the other side of the stick, whereby they came in to inject liquidity. So liquidity somehow had dried up by the end of the week. That could be possibly because of the impact of this infrastructure bond sale, but we'll be seeing it in a while, but we'll see if that was the case over the course of this week. In terms of net domestic borrowing, we are at 318 billion. The revised target is 600 billion. So that makes it 53% of the net domestic borrowing as at last week, end of last week. So moving and looking at the infrastructure bond sale, this is the second bond sale in a month, which was quite a fast one. We've never seen a month where there's been two auctions, but here we are. The first one was the 2-year bond sale that happened 2 weeks ago, and then last week we saw the infrastructure bond sale. So the total amount that was being sought was 50 billion, of which total bids received was a whopping 125 billion, and with total bids accepted was above the amount sought by 31 billion shillings. So the coupon was market determined, which was ideally the weighted average of the accepted bids, which was 12.27%, and because the coupon is equal to the yield, so now the yield, the 12.257%, the price per 100 is still 100. For those of us who are joining us the first time this year, we've been having, whenever we talk about the bonds and the pricing, there's usually an inverse relation between the coupon and the yield. So if the coupon rate, for instance, in our cases, had it been at say 12.3%, and the weighted rate of the yield is at 12.257%, the price per 100 will have been lower than 100. Say it could have been 99 or 98. So there's that inverse relation. If the coupon is higher than the yield, the price per 100 is lower. If the coupon is lower than the yield, the price per every 100 is higher than 100. So that's essentially just to distill this point of the inverse relations between coupon and the yield, or the pricing on the yield and the pricing of the bond and the yield. So our week's trade is still on the infrastructure bond that was issued. We expect that trading will now ramp up in the week. It's settling today, so trading will start in earnest tomorrow. We expect that the 44 billion that was rejected from the auction will now propel the demand for this paper, and we're seeing investors who bought into this paper to starting to sell them between 12.15% to 12.2%. Remember that the yield was 12.257%. So for them to make profit, they'll now be selling them at a lower yield from what was there in the auction. So they'll be selling them, of course, at a profit. So for investors who are selling, they'll be selling it at a lower yield, and investors who are buying will be buying it around these levels, 12.5%, 12.2%. So that marks the end of my presentation. So let me just hand it over back to Daniel.
Thank you very much, Churchill. And Now we go to the Q&A section. Now, if you have any question, you can either use the Q&A or the chat section to send your questions, and Churchill and Gerald will are here to answer them. Now, we apologize for the sound today. It hasn't been good, but we are improving as the webinars go by. So, Churchill, there's a question for you here. First of all, Kevin Kakuti starts with Happy New Year, team. Happy New Year. Great to see you. Thanks for the weekly briefings. When the IFB 2021, the 16 year was advertised, the rate indicated in the prospectus was market determined. How does a prospective investor know the approximate percentage rate? Churchill?
Thanks, Dan. Thanks, Kevin, for the question. Happy New Year to you too. I don't think it's late to wish Happy New Year at this point in time. So back to your question, market determined. Yes, it tends to be a bit hard for an investor to know where exactly to place the yield because you don't have any guide. And that's where we come in. Usually before the auctions usually are held on a Wednesday. Before the auction, we usually put out our expectation on a Monday, the Monday before the auction. So that's where we also guide investors like you who perhaps are struggling to place their bids. That usually is a guide. We have conversations with our dealing team who have a pulse in the market where perhaps the sentiment, they know where the sentiment along where the bids will be. So they also assist us in terms of putting out the recommendations out there to clients. And if not, to be on the safer side, you can also put in the non-competitive bid. So with a non-competitive bid, essentially, you don't explicitly put out a bid, but now your bid will be the market average. Like for instance, the 12.257%, that was now the accepted yield. So that is also another route that you can also be able to pursue. But bottom line, we give our recommendations the Monday before the auction on Wednesday.
So Kevin, you can be sure to subscribe to our newsletters to receive this to receive news about new prospectus bonds that are being released. Brian Otieno has a question. For Gerald, that is it recommended to buy Safaricom shares now? And then in addition to this, Powell Ochieng is also asking, is Uchumi still in the market? I don't see any branches open. So maybe Gerald, you can speak to that.
Thank you, Brian, and thank you, Powell. For Safaricom, I think the price is a bit high up there. I think recently it has recently logged an all-time high, about 37 shillings, has bounced down, has come down basically, I think 36 thereabout. On a fair value basis, I think that's way above where we would consider as an ideal entry point. I think given the profit taking we are seeing over last week, I think there's going to be much better prices compared to the 36 levels that have been there in the recent past. Powell, is Uchumi still in the market? Yes, still trading in the market. Branches, yes, of course, we have all observed the challenges the business has been going through. It's still struggling, but the share is still open for trading in the NSC. Thank you. Back to Daniel.
Okay, thank you very much. Cliff Mayaka is asking, no, he's actually wishing us a happy new year. and asking what is your view on interest rate movements in the short term to mid-term horizon. That is to you, Churchill.
Thanks, Clay, for the question. If I correctly understand the question is on the fixed income, what's the outlook of yields movement, say in the next short to medium term horizon, say, can say 6 months to 12 months down the line, hypothetically. There's usually a debate between what's the short term, medium term, but hypothetically. So in our view, we are seeing there's an upward pressure on yields coming from the inflationary pressures that we'll see, but that will fade off after the end of the quarter. We are seeing that this impact of the VAT, increase of VAT, will have an impact in a big way in the first quarter, but by the second quarter onwards, it'll have reduced. So that we expect that in this first quarter, there'll be that upward pressure on yields, which will still will extend the trend that started in the fourth quarter of last year when we did an analysis of the quarter-on-quarter yield movements. Our fourth quarter, this was that steady uptick of yields across the yield curve, and that also coincided with the inflation pressure that started, but albeit in a benign way in the fourth quarter. But for first quarter, we still expect that trend to continue before it steadies from the second quarter onwards. But ideally, we are seeing that yields will grow, will climb up marginally, close to, on average, 0.1% across the yield curve. If I'm answering Cliff Mayaka's question correctly, if that's the question that you put it out.
Okay, thank you very much, Churchill. Two questions here directed to you two. Irene Karaoke is asking, how do I go about buying bonds and stroke T-bills? And specifically now to you is, which do you recommend for long term? And then Morris Robert is also asking, is it possible that banking stock prices will come down before the announcement of financial results in 2 months due to profit warnings by most banks? That will be for Gerald. Okay, Churchill.
Thanks. To start with Irene's question about how to go about buying bonds and T-bills. First, as an investor, you need to have a CBS account, either directly opening it with CBK or opening it with an investment bank such as Genghis, or whichever bank that you bank with, you can be able to open a CBS account with. And from that, you can now be able to buy bonds and T-bills. Of course, over and above that opening, there are some KYC documents that will be required from your end if you are opening an individual account with an investment bank. So some of the KYC documents that will be required from you is now an ID and colored passport photos over and above the application form that you'll be filling out. That said, which bonds do you recommend in the long term? Right now, we are seeing opportunities in the bonds which have maturities between 5 years and 10 years. So bonds that will mature from 2026 up until 2031, that's where we are seeing opportunities. First is because on the short end of the curve, basically bonds maturing between right now up until 2025, there's been some exaggerated demand, or there's been so much demand on that part of the bonds. So that means that prices are quite elevated. So now the next best place that we are advising our clients is now the medium term, basically now the 2026 up until 2031 maturities. But we can be able to get more advice from our wealth managers or our dealers on the best bond to get into. There's a question about Shadrach Mozige about money market funds, interest rates not moving in relation to T-bills and bonds. That boils down to their allocation, because money market funds, they invest into cash and cash equivalent instruments. And it could be as a result of, say, perhaps a lower allocation to T-bonds and T-bills. We've seen that yields have been increasing on T-bills and T-bonds. To an extent also they've been increasing, but perhaps most of it is is perhaps tied out in different asset near cash instruments which are paying lower rates. So that could be the major reason. That other units, now the asset management, that the ones who run our money market fund, they might have the better detailed analysis of where the funds have been invested. But if you might check out our website, we usually put out the fund fact sheets for our money market fund, and there also gives some breakdown of where the funds have been invested. So out of curiosity, you can also just visit our website and look at the fund fact sheet, just to help you get a better understanding of why there's not that correlation between money market funds and also the T-bills and T-bonds. Back to you, Dan. Dan, you are muted.
You're on mute, Daniel.
Dan, you're on mute.
Can you hear me now?
Yes, we can hear you.
Yeah, so in addition to that, Shadrach can also register for our Genghis personal investment webinar, which talks more about money market fund and how to start investing in money market funds. Now, one last question from Kipkosgei Tanui is asking, is Centum a long-term buy? Over to you, Gerald.
Yes, Daniel. First, I'll address some earlier questions about by Maurice about whether prices for the banking stocks will come down. I think they will, because definitely there's that impact in terms of provisioning levels, and also the expectations that most banks will either significantly cut on dividends or totally eliminate dividends. I think there's going to be some downside pressure on pricing for most of the banks. However, last week, I think some of the banks, I saw some downside pressure on the banks, some of the large banks. And I think this is going to continue as we head into the financial year announcements. For Centum, I think Centum is it's a bit complicated, because from the recent announcements, I think while there was that impact of COVID on most of the portfolio companies and its performance generally, I think the dip was much more than would have been expected by the market. And I think at some point after announcements, they talked about the price came to some record low level. So in terms of long-term outlook, you need to look at where the strategy is, and it's mostly pardon?
You can maybe add your volume just a little bit so that people can actually hear you.
Okay.
Yes.
Is that better?
Yes.
Hello? Yes, okay. Yes, so for Centum, there was that impact on most of the portfolio companies from COVID effects. I think the performance was much lower than what would have been expected. On a long-term basis, I think you have to look at the strategy where the business is looking at in terms of its 5 to 10 year strategy, and it's basically real estate, right? And when you look at real estate over the recent past has been having challenges. I think it's one of the industry that has a lot that is moving in terms of customer behavior, in terms of investments, and given that most of now its investment are focused on that end. I think the strategy would be what is the outlook and what is the strategy towards the real estate side. There was Daniel. Was there another question? I think you're on mute.
Your long-term view on Centum.
Yes. So as I've just said, the long term is basically about where it's moving in terms of its strategy, which is basically real estate, right? Real estate, it's not something that for now, because it's not a sector that we keenly follow up on. We cannot be able to say for sure that this is the direction that the real estate sector will be moving, or how it will perform in the long term. But if you are very keen on this question, we can always discuss after this in detail, and I can have a look at the numbers and have a more detailed discussion with you. Back to Daniel.
Gerald, John Masharia is asking, what is the future prospect of rates market in Kenya, considering there is only one in the market?
So again, it's about real estate, right? The performance of real estate will inform the performance of the rate. I think last year there was, of course, that impact, and there was a pressure on pricing on Fahari rate. So if you have an outlook in terms of where the real estate sector will be and how it's going to perform, and the structural changes that are happening in that space, then you can have a good view in terms of how the IREIT will perform. Back to Dana.
Yeah. Let me just chime in also on that. There's the Econ, the green bond, the one that was listed early last year, close to 5 billion. So the idea was now to be able now to move gradually into the D-rate segment, the development rate segment. Fahari is high income rate segment. So basically the funds that they have received now, to be able to structure it in a way that now as they develop the properties, I think it was around 10 properties that it's in their pipeline. So they'll now develop some D-rates along those lines. I haven't seen traction around that, but that was the intention, even with the Econ green bond. Yeah. So back to you. The question that.
Yeah, and for Econ Churchill, maybe to add on, I think the idea was quite unique. They were targeting student accommodation. So that was a very unique strategy in terms of real estate sector, because in the real estate sector, there's those structural adjustments that are happening. For example, you find that the high-end commercial space is having challenges, right, over supply. The high-end real estate, for example, is also having challenges, but the low-end or the affordable end still has a very large demand. So those are some of the drivers that will be moving the real estate sector. Back to Churchill or Daniel.
Yeah, there's a question that James Kiarie had asked in regards to the IFB 2021, that's the infrastructure bond that was issued, whether to buy it once trading starts, that's tomorrow, or wait for the next IFB offer. So the likelihood of a next IFB offer, in our view, low, appears to be an issuance in the near term. And where are we coming from this view? We're looking at the changes that has come from the macroeconomic developments. whereby those are the tax reversals that were done at the start of this year, and also some additional tax measures. So that means that on the revenue side, the target for revenue will go up. Of course, that will be offset by the expected supplementary budget, which will be biased towards a higher budget as opposed to reducing the original budget. And on the other side, we have this facility, the IMF facility, that is meant to be hammered out by the end of this quarter, in our view. So that means that the net domestic borrowing, right now we are saying it is high at 600 billion, will come down lower, will reduce lower. And at this point in time, net domestic borrowing is slightly ahead of the curve, meaning that it's there have been Treasury has managed to borrow close to 53% of the 600 billion target that we had in as per the budget review outlook paper. So there's a likelihood that even that target will come down, the net domestic borrowing, because we have this additional facility from IMF which had not been factored in. So that means that there might not be pressure by Treasury to meet its net domestic borrowing. Already it has issued a 2-year paper infrastructure bond in 1 month. So the likelihood of an IFB in the next 5 months is quite low. So that means that your opportunity for getting into an IFB is right now as it starts trading in the secondary market. That's how we are seeing it. So back to you, Daniel.
Thank you very much, Churchill and Gerald, for the insights from the past week and the week ahead. We ask everyone, maybe if you want now to start, I think there's another question from John Masharia. Is there too much complaint of non-compliance in dividend payment as agreed semi-annually by Fahari irate? Should we keep buying or just sell? Churchill?
Maybe Churchill, are you comfortable with that, or maybe I can take that? So I haven't seen that non-compliance or that info that you've just shared. However, in terms of dividend, you know, IRATE should ideally pay about 90% of its dividend, of its earnings as distributable dividend to shareholders. So I think it's something that I can follow up on and be able to advise you accordingly of what has been happening. You'll find that Fahari is usually not one of those stocks that we keenly provide research coverage on. So we cannot be able to advise whether you can continue buying or continue selling, but we can have this discussion one-on-one, and you know, after having looked at the financials and how the business has been, then we can be able to give some good advice thereon. Daniel?
Okay, John Kamau is asking, apart from EABL stocks, which one should one buy? Gerald?
Yes, so from our playbook last week, I think for most of the counters, they are trading at good price levels. I think for buys, we have EABL, we have Kengen, we just talked about Kenyari this morning. And then from the banks, we have KCB, we have Equity Group, and then we have ABSA. So we have a very diversified buy recommendations, and you can be able to look at this to look at these stocks on a long-term basis. So in the short term, there's still going to be a lot of uncertainty in the market. What's going to happen? How financial performance is going to be? But on a long-term basis, after the effects of the pandemic have basically weathered off, then you can have some good return on some of these counters. Daniel?
Yeah, I think there is interest about the rates. So Gerald, I think we can maybe share our email address, that is research@genghis-capital.com. I will type it here and in the chat section so that you can maybe send your questions and highlights of what you'd want to know so that Gerald can actually check up on them. So Chege Mwangi is asking, is Safaricom a sell now or wait for a drop?
Yes, so I expect some downside pressure on its price. I think we have already seen this over last week after hitting an all-time high of about 37 shillings. So it's coming off. I would pick Safaricom at much lower levels compared to where it is currently trading at. I think our fair value is about 32.72. Basically the fair value of the stock. So current pricing is much higher than that. So at lower levels I'd pick, but at current levels, I think within a band of about 10%, I would recommend a hold at the current price levels. Daniel?
Yeah. Thank you very much, Gerald. I think next week you'll have to speak up so that people can actually hear you well. And this coming week, now you can start actioning on the knowledge that you've actually on the news that you've gotten from our two able speakers. And you can do this by downloading our application called Jikuze, which is available in Apple and Google Play Store. Register, and with that you'll have a CDS account and you'll be able to start trading. For bond trading, you can email us at dealing@genghis-capital.com. Thank you very much for attending our first webinar of 2021. We look forward to seeing you in the other subsequent webinars, which will be happening every Monday from 9 to 9:30 a.m. Thank you.